Well, hello there. I'm Bill Bush with Horizon Financial Group, and welcome to today's Financial Matrix presentation. Our topic, what you need to know about Social Security while on the runway. So in our book, The Runway Decade, we talk about how people in their 50s are on this runway toward retirement. It's kind of in the near future, and it's time to get ready for takeoff. So that means getting ahead of things before they happen and being prepared. So in our book and on our website, The Runway Decade, we introduce you to this, the financial matrix. Whoops, there we go, the financial matrix. And it's a grid of many of the things that most people need to consider when they think about retirement. Now, all of these things may not apply. In some categories, certainly, may apply more than others, but there are really just 7 main topics to the matrix, and then a lot of other connected things under each one of these topics. So today we're talking about that third column over, retirement planning, and specifically it touches a couple of areas, the Social Security planning, and then of course retirement income planning, because Social Security a big part of that. Now, when your parents retired, they probably didn't think too much about Social Security. They may have gone down to their local office as soon as they maybe turned 65 or maybe even 62 if they retired early, and just applied for benefits. They took their benefits for granted, probably didn't ask many questions. But now people are approaching that Social Security question in a very different way. So most people, tend to minimize the value of Social Security. If they understand that they're likely to get something back from the system at all, they think it's probably going to be a minimal amount, not really enough to count on. But Social Security is far more valuable than most people realize. And the first thing is that Social Security is one of the few sources of income that you can't outlive. So if you're worried about running out of personal assets in your old age, you need not have that fear with Social Security, because it continues until you die. And of course, the longer you live, the more you can extract from the system. So you see here, if your benefit starts out at $2,000 per month and you lived 10 more years, you would receive nearly $300,000 in lifetime benefits. If you lived 20 more years, $600,000 in lifetime benefits. And if you happen to live 30 more years, you would receive over $1 million over your lifetime. So, and that, by the way, is just assuming a small cost of living adjustment. COLAs is what they call those, cost of living adjustment, of just 2%. So over a lifetime, and in someone in a retirement quite long, 30 years, that could be $1 million. Second thing to point out is that Social Security offers annual inflation adjustments. So if your benefit starts out at the $2,000 per month, and if your annual cost of living adjustments, those COLAs, are just 2%, in 10 years, you'll receive $24.38 per month. That amount would have increased by that because of the cost of living adjustments. In 20 years, that check becomes $2,972. And in 30 years, your check expands to $3,623. Now, of course, there's no way of knowing exactly what the future cost of living adjustments are going to be. 2% is kind of a reasonable conservative estimate, but certainly that cost of a living adjustment just last year was much more than that. We'll probably see one greater this coming year as well, because it's tied to inflation. Now, when your Social Security benefit is calculated, it's based on a couple of things: how much you earned over your working career and the age at which you apply for benefits. Those are 2 big factors. And the formula for calculating Social Security, it's pretty complex. You may or may not want to follow along with this. Some people find the formula interesting. And in a moment, I'll show you a couple of ways that you can estimate your own benefit without having to go through the formula. But the general process goes like this. First, Social Security looks at your annual earnings over your entire career, and they index them for inflation. So they pick out the 35 highest earnings years, the 35 highest years of earnings, and include it in the formula. The indexed earnings, so those are totaled up and divided by 35 to come up with an average. And if you don't have 35 years of earnings, by the way, the missing years are filled in with zeros. So that would have the effect of lowering your Social Security benefits for people that maybe have had to take time out of the workforce. A good example would be, maybe to raise children, but they may be eligible for spousal benefits, which we're going to cover in a moment as well. Next, that formula is applied to your average indexed monthly earnings, that AIME you see there. This formula is applied to your average indexed monthly earnings, and you'll see that it spits out what's called your primary insurance amount, your PIA. So this is the amount you'll receive when you reach full retirement age. And by the way, full retirement age, you'll see that as FRA. It could be 66, 67, or some age in between. It depends on when you were born. So each year, those cost of living adjustments are applied to your benefit to help you keep up, just with the cost of living, the cost of goods and services. So here's an example of how the benefit formula would work for someone who was born in 1960 and who earned the Social Security maximum every year since age 22. So the average index monthly earnings in this case worked out to be $11,430. So in calculating this primary insurance amount, you have 3 bend points here. The first $1,024 is going to be multiplied by 90%. All right. The second amount, the amount in between 1,024 and 6,172, which you see the math out to the side, that amount is $5,148. That amount is multiplied by 32%. And then any amount over the 6,172, which in this case is $5,258, that's multiplied by a smaller amount, 15%. And then you add up all 3 of those bend points, those numbers, and that totals up to the PIA of $3,357.66 in this case. So that is the amount the worker would receive at full retirement age. Told you it was a complicated formula, but fortunately, you don't have to figure this out all by yourself. So FRA, full retirement age, that's the age which you can claim full unreduced benefits. And it used to be 65 for everybody. In fact, a lot of people still think, that it is still 65, but it's not. Right now, we're seeing, of course, a higher full retirement age that phased in as a result of amendments that were made back in 1983, actually. So for anyone born between the years 1943 and 54, their full retirement age is 66. Anybody born 1960 and after, it's 67 is the FRA. And those you see born in the middle from 1955 through 59, their full retirement age is 66 plus a certain amount of months, depending on the year you were born. So what if you apply for early benefits? I said, remember, the PIA, primary insurance amount, is the benefit you receive at full retirement age. But what happens if you take the benefits before FRA? Well, your benefit's going to be reduced. You're going to receive a percentage of your PIA depending on when you apply. So if we look at the second column here, if your full retirement age is 66 and you apply at age 62, you're going to receive 75% of your PIA, and it gradually goes up until you reach PIA of 66, or FRA in 66 in this case. So you see it's 63, it's 80%, a 20% reduction. And if your full retirement age is 67, looking at the third column, and you apply at 62, you're going to receive 70% of your primary insurance amount. And so these amounts, they're actually prorated monthly. So you could apply at any time after age 62, and your benefit is going to be reduced by the appropriate amount there. So what happens on the other hand if you apply for Social Security after that full retirement age? Well, you earn what's called delayed credits, and it's a pretty good 8% per year that you delay. So second column, if your full retirement age was 66 and you waited a year, you would get 108% of your PIA. And so forth. You see on the 67 column, the third column over, if you waited till 68, 108%, all the way up to age 70. After age 70, you don't earn any more delayed credits. So it really obviously doesn't pay to wait anymore after age 70 to apply for Social Security, but 132% of your PIA at age 70 if your FRA happened to be 60, and 120% if your full retirement age happened to be 67 and you delayed to 70. So pretty good. Now, I'm guessing you're probably not too interested in doing all that math and calculating your AIME and your average index monthly earnings and your PIA and those reductions in credits for early or late filing and annual cost of living that could raise the benefit as well. Well, you can good enough find out an approximate amount of what you would expect to receive in benefits. And there's several ways to do that. You can refer to your annual Social Security statement. Those are available online at socialsecurity.gov/myaccount. You need to set up an account and you'll have to answer a number of security questions to do that, but encourage you to do that. And then secondly, you can use the retirement estimator on the Social Security website. So this calculator taps into your specific earnings history and looks into your personal identifying information, of course, Social Security number, birth date, et cetera, mother's maiden name. It is a secure site, don't worry. And then please note, though, that when you do that estimator, the retirement estimator there does not factor in the cost of living adjustments into your age 70 benefit. So that means your actual benefit would likely be higher than what they indicate. But we do have calculators that can do the cost of the COLA adjustments. So if you know your PIA, we can certainly help project into the future what those benefits might look like. You also might want to try, there are calculators on the SSA.gov site /planner/benefit calculators. You see right there. So a few ways that you can get kind of an estimate of what the benefit looks like. So the decision of when to apply for benefits, kind of becomes one of the most important, and certainly it can be complicated, and it can literally make a difference of thousands of dollars over your lifetime, just as we showed when you think of the reduced benefits or the delayed, the bonus you get for waiting. But before we get into number crunching, it is important to think about that decision of when to apply depends on a lot of factors unique to your situation. And these, of course, can include, you see your health status, your life expectancy, your need for income at any given time, and whether or not you plan to work is a factor, and if you're a surviving spouse, and whether, of course, you have, other resources. All of those things kind of come into play when you think about, well, when should I turn on the Social Security spigot? When should I apply? And, it can be, and needs to be maybe some analysis, some customized analysis involved. Here are some key points, a few points to remember though. You apply early, the benefit starts out at some fraction of your PIA, 75% or 80% or whatever, and it remains at that percentage the rest of your life. It does not go up to the 100% when you reach your full retirement age. The cost of living adjustments do apply, and they actually magnify the impact of the early or delayed retirement, because the annual cost of living adjustment is going to be either applied to a lower number or a higher number, and that's going to cause disparity to increase each year. So the when to apply question can, in fact, it can impact survivor benefits as well. Higher earning spouses, they're kind of encouraged, to delay benefits to age 70, because that's going to give a surviving spouse the highest benefit after the first one passes, the higher earner passes away. Now let's look at some strategies for maximizing benefits. We'll look at a few here. And the first thing you can do while you still have time, is to improve your earnings record. So first, log in, check your annual statement, make sure your earnings record is accurate. Mistakes are rare because the earnings kept on file at Social Security were actually reported by employers when they submitted your Social Security taxes. But, mistakes can happen. especially for self-employed individuals. And those earnings records are actually taken from tax returns. And then the next thing to consider might be how to improve your earnings records. So if you don't have 35 years of earnings, can you work a few more years so those zeros won't fill in the missing years? And if you've had several years of low earnings earlier in your career, now you can make up for it maybe now if you're in peak earnings years. So those low earnings years will get replaced with higher earning ones. So that's a couple of things to think about. And even if you start receiving Social Security and continue to work, your earnings record also continues to be updated. But it is important to note that if you start receiving Social Security before your FRA, your full retirement age, and if you earn over a pretty small amount, $19,560 a year, $1 of benefits is going to be withheld for every $2 you earn over that threshold. We'll talk about that a little bit more. So strategy 2 for maximizing Social Security is applying for benefits at the optimal time. And we made a case for delaying benefits because you think of a bonus in that situation. It's going to result possibly in the highest lifetime benefit for you and your surviving spouse, giving, if you think about just average life expectancies. But there's really no one size fits all answer to this question. It is good to use the calculators and sort of project out a couple scenarios. But the important thing is to apply that is at the time that is really optimal for you. Another important consideration we talked about, mentioned it, is, if you plan to work. And so that $19,560 comes into play. That's for 2022. $1 is going to be clawed back for every $2 you earn over that amount. But just remember that it's not truly taken away. Your benefit is actually going to be adjusted upward later when you turn full retirement age, as if you applied a little later. That means that if some of your benefits are withheld due to the earnings test, your new benefit's going to be higher, as if you had started at 63, 64 and instead of 62. So, we do tell folks, don't let the annual earnings test discourage you from working. Know that it's there for sure. The more money you earn, the more money you're going to have. And Social Security does not, in effect, penalize you for working. Once that adjustment is made, you are going to end up with a higher benefit for the rest of your life. And of course, the earnings themselves are going to contribute to the financial well-being. But then we do point out this, it is important, if you just want to avoid the earnings test entirely, just wait till your full retirement age or later to apply for benefits, because the earnings test goes away after FRA. So if you reach your full retirement age and you're continuing working and then you turn Social Security on, there's no earnings test involved after FRA or later. Coordinating spousal benefits. So strategy 3 would be maximizing, if you happen to have a spouse, what's the best way to look at both of those scenarios to come out the optimal for the couple. And, maximizing, it can be complicated for sure, but understanding all the considerations and doing the calculations, it is actually, possible to come up with the right solutions. You think of those factors we mentioned before. When you have two people involved, certainly health, longevity, and those things come into play when you think about all that. And then there's the minimizing of taxation of benefits. This trips a lot of people up that, they didn't know that Social Security benefits actually may be taxable. What? I thought it was a tax. It was coming out of my paycheck all these years. But a strategy 4 would be maximizing your benefits to minimize the tax. And so ways to do that, minimize taxing, is lowering your other income, especially investment income. But you should be aware that municipal bonds you see mentioned here, that actually, it's usually tax-free, but it does count as income for the purpose of calculating the tax on Social Security benefits. Anticipated required minimum distributions from your IRA, which may cause you to be in a higher tax bracket. and may cause some of your Social Security benefits to be taxable. That could be a factor. Some people say, well, consider drawing down your IRAs before age 72 or converting traditional IRAs to Roth IRAs, which might generate tax-free income if you're on the runway decade in your 50s. Does that make sense to look at a Roth option there? Delay Social Security in order to reduce the number of years that you might be subject to the taxes. And then, of course, other things, just reduce your expenses, pay down debts, adopt a simpler lifestyle, which, usually that happens eventually in retirement, but it's certainly something to think about. And of course, continue to manage taxes throughout retirement, not just the few years. And as always, we like to recommend, hey, consult a tax advisor about your individual situation, because there are several things that might make sense that we mentioned and things that might not make sense. Coordinating Social Security with your overall retirement income plan, that's the fifth strategy. And so you're going to have a lot of sources, in retirement. Social Security, as we said, is one you can't outlive. And it can be quite a considerable piece of that pie. It is important to consider that in context of, pensions and IRAs, 401ks, the RMDs at age 72, your investment portfolio, maybe your brokerage accounts that may be subject just to capital gains taxes, or your plans, again, we mentioned this before, of working in retirement. All of those resources kind of coordinated to give you the income you're going to need for the rest of your life. So please, again, don't be afraid to ask for help, whether it's from a financial advisor or a tax advisor. We kind of find, the retirement planning is easy when it's a matter of, the accumulation phase, when you're sticking away salary into the 401k or putting away money in the IRA. But when it comes down to kind of convert that nest egg into an income stream, well, you certainly don't want to make sure that it doesn't run out, I should say. And Social Security kind of being that bedrock, because it doesn't run out as long as you're alive, right? It should be a part of your retirement program, but certainly coordinated with those other sources, to give you the stability, and certainly it's in its name, the security, of course, you deserve. Get this question a lot. Will Social Security be there for me? And, certainly there's a lot of noise out there, and that's led to a lot of misunderstandings and certainly some fears about the whole solvency of the Social Security system. But let's take a look at what the Social Security trustees say. And every year they publish a comprehensive report that shows kind of that long range outlook of Social Security. So the OASDI, that's it. That's the trust fund drawdown we're going to look at. Social Security was designed, as this pay-as-you-go system. So payroll taxes from current workers going into a trust fund that are immediately paid out to current retirees. But because the baby boomer population, huge cohort, they've been in their peak earnings years, and that trust fund has certainly accumulated more than needed for the current benefits being paid out. But right now, that trust fund you see here, has $2.9 trillion, which is invested in special issue treasury securities. And as baby boomers are certainly starting to retire, they're retiring now, those trust fund assets are gradually being drawn down. And so, they are going to dissipate. That's the amount in the trust fund. And as this graph looks at over the next 75 years, the costs are going to exceed the income coming in, but there are enough reserves in that system to pay 100% of the promised benefits up until the year 2035. Now, after that, unless something gets changed, the income coming in every year is going to be sufficient to cover about 80% of the promised benefits. So at 2035, unless there are changes made, you're looking at, okay, there's enough inflow coming to pay out 80% of the promised benefits. And you see, as they extrapolate this over longer periods of time, way long after I'll be gone, it gradually goes down to 74%. But that begs the question, what's it going to take to restore the solvency, because 2035 is not that far away, So Social Security, definitely not in imminent danger, but certainly the earlier that reforms are instituted, the less painful they're going to be on everybody. And of course, that fear will certainly go away. But here's a few of the ideas that have been proposed. And the first one is, increase the maximum earnings subject to Social Security tax. So in this year, 2022, you pay that 6.2% and the employer pays the 6.2% up until you make 147. After that, you're not paying that 6.2% anymore. So if that ceiling were raised, and there's been talk about, well, what if they raise that ceiling to $400,000? So you're paying that Social Security tax all the way up to there to raise the ceiling. That's one of them. Another proposal calls for raising the normal retirement age as life expectancies increase, but I don't know, I've heard that life expectancies actually have gone down a little bit because of the pandemic and other reasons, but that is something that wasn't done that long ago, right? In 1983, when they changed things around, they boosted the retirement age up. So healthy people are certainly living longer, but life expectancies in general, because of some outlier factors, maybe are going down slightly, but raising that normal retirement age would be another one. And then still another one, lowering benefits for future retirees. That probably wouldn't play well no matter what side of the aisle you're on, but just giving smaller cost of living adjustment, those raises every year would be the other way, but that, some of that would be minimal. There are certain proposals here that might make a little more impact than others, but if you want to learn more about some of those reform proposals, the American Academy of Actuaries, their website is actuary.org. I don't think we have that on here. Actuary.org has a list of some of those proposals, and it is going to be something that is going to be talked about a lot in the next several years. But I think because it's still 13 years away, they feel they can kind of kick the can down the line a little bit. But the pressure to get that solved is going to increase, I believe, just because of the uncertainty and the fear factors. So certainly questions. Oh, excuse me, my mic just fell. Certainly a lot of questions, and covered a lot of ground today, but it's not uncommon for people to ask these type of things. When should I apply? What if I want to keep working? What if I've already applied? Of course, how much will my benefit be? Talked about ways to do that and look at maybe some estimates. Coordinating spousal benefits is an important thing. What's the best long-term strategy for my situation? And what should you do next? And of course, we'd be glad to help you out with any of those questions. The Social Security question is part of our holistic financial planning process. That's why it's on that financial matrix we talked about at the beginning. And so certainly, reach out to us, or if you have a financial advisor or a tax person, certainly, reach out to them, because Social Security, we think it's too important for guesswork. Definitely want to make an informed, knowledgeable choice about your filing situation. And it can be a significant piece in your financial plan. They say on average, Social Security will replace about 30 to 40% of your pre-retirement income. It does depend where you fall in the earnings category there. It replaces obviously a greater percentage of lower income folks and a lesser percentage of the higher income people. But you certainly want to protect your nest egg and maximize your income in retirement. And so if you have any questions for us, or if you want to reach out and just have a meeting with one of our advisors at Horizon, here's the best way to get us. www.horizonfg.com/contact. There's a form there, just fill out, or you can email us directly at info@horizonfg.com. And just reach out and schedule a meeting, and we can discuss whatever's on your mind. And so with that, we hope you found today's info helpful, as you look ahead at your future retirement and Social Security strategies. We do have a handout available It should be in the chat section. I put it in there. And so you can download that. That PDF is available for download in the chat section now, and give you a couple minutes to access that if you would like. It summarizes some of what we talked about today, but it also covers things like survivor benefits, spousal benefits, the maximum PIA amounts, cost of living adjustments, kind of a historic look at what those have been. Even gets into Medicare Part B and other things like that. So if you want to go to the chat section, should be in there. If not, it is on the Runway Decade website under the downloadable resources. If you've read the book and you've gone to our downloadable resources and put in your email to access that, you can just download a copy there. It's the same thing that's going to be in the chat section. But yeah, I see it in the chat there. So if you've already subscribed on the Runway Decade page, just go back into that bookmark page and it'll show up there. All right. And just a final reminder about the book, Runway Decade. We mentioned some of the resources available there. Go to runwaydecade.com. You'll also find we've started a podcast, the Runway Decade podcast, where we talk to just interesting people we know that are in their 50s and kind of what they're going through and kind of how they're figuring out life and what they're looking forward to in retirement. And so plenty of other resources and news available located on the site. So that's going to do it. I think we're a little over time. We said we'd go a half an hour, but certainly want to thank you for joining us and hope to talk with you soon. And if you, again, I'm going to go back to I think I'm going to go back to it. Yep. Here's our contact info. If you'd like to reach out, be glad to answer any questions you have. So with that, we'll sign off and say thanks for joining us and hope to talk to you soon.